Good morning, ladies and gents, and welcome to February 2026 installment of the Blackfinch 10-minute market forecast. Thank you for joining us today. My name is Jordan Kent, Distribution and Sales Exec for Blackfinch Asset Management. And I'm joined this morning by Assistant Portfolio Manager, Mr. Josh Clayton. For those joining us for the first time, we use these webinars to provide you with an overview of what are, in our opinion, some of the most important headlines across markets today, preparing you for your client conversations and giving you an insight into the rationale we apply to the management of our own portfolios. If you have any questions during today's session, then please be our guest and submit them using the Q&A box. Otherwise, we'll provide our contact details during the closing of the webinar if you'd like to reach out to us directly. Now, before we begin with this morning's content, I would like to note the information we cover is intended for financial professionals only and therefore should not be taken or interpreted as financial advice. Today, we have three themes we'll be covering. First, will be a look at the changing landscape in commodities, particularly that of gold. Second is the latest position of the Federal Reserve. And thirdly is the emergence of the K-shaped profile of US consumers. I'll now pass over to Josh to dive into the detail of these topics. Good morning, Josh.
Thank you, Jordan. Good morning, everyone. Let's get stuck straight in today's themes. And really, as Jordan said, there's no better place than to start with gold. We all know that it's been on this remarkable run recently before seeing this quick pullback in returns at the start of the week. So before we bring in the charts, let's just frame the narrative first. For those that have been closely following markets, we know investment returns have been stellar, especially in sterling terms, and part of this can be linked to a falling US dollar over the last year. So when that dollar falls, other economies can benefit as exporting goods becomes more attractive, or they can pay down dollar-denominated debt and so on. So investors are very much sitting on some gains at the moment, meaning some sensitivity can increase, it can move upward. And historically, the US dollar is this well-loved safe haven asset, but as we've mentioned before, that isn't the case this time around. And investors are looking elsewhere. And this brings in this role of precious metals, including gold and silver and some of the other metals. But what we've seen, especially this year in 2026, is geopolitics is front and center, and with that comes volatility. So it's less about the traditional inflation protection that gold can offer, but more about what we're talking about here. And what stands out for me when I look at this chart on the top is that how retail investors' participation surged as the price of gold has accelerated. If you're just looking at Google search interest in buying or investing in gold, it's moved almost vertical. And that's often a sign that momentum rather than fundamentals is driving some of the return. And at the same time, consumer price expectations for gold rose sharply, which is the bottom chart on the screen here, meaning we now have this melting pot of rising prices, rising expectations and attention. And that's a classic recipe for momentum-driven markets. And once that happens, price action starts to feed on itself. Rising prices attract attention. Attention attracts capital, and gradually gold stops behaving like a defensive hedge and starts trading more like a risk asset. We then had geopolitics add fuel to that fire. Ongoing tensions reinforced the narrative that gold was this safe place to be, which helped push prices higher. But the key point here is that some of this momentum-based rally is fragile, and US politics showed that. Trump made comments on the Fed in particular to the prospect of a more credible Fed chair called Kevin Warsh, and this caused a rapid repricing. So the US dollar strengthened, your real rates adjusted, and precious metals had some of the sharpest daily moves recorded. For gold, if you're using the chart, it's the sharpest move since 2013. I think for silver, it's nearly 30 years. It was almost a 26% fall in value. This is what the chart's showing here on the screen. So the gold and the dollar with these big intraday shifts. The dollar recovered in value slightly, so that safe haven asset slightly improving, or the older safe haven asset. And there was this big intraday step down in gold. And the takeaway here is that gold suddenly hasn't failed as this safe haven asset, but maybe its risk reward profile slightly changed. And once an asset becomes crowded or is sentiment driven, it becomes far more sensitive to shifts in policy expectations in the dollar. And that's what we've seen play out here. That leads us neatly onto the second chart, second slide, and this is to do with the Federal Reserve last week. And markets have been grappling with kind of two near-term risks. The first is political pressure on the Fed and uncertainty around the next chair. And both of these, at least for now, the nomination of Kevin Walsh was viewed as a more tempered pick than some of the alternatives that people were speculating. And it's certainly a sigh of relief for investors across global markets. Walsh has historically been on this kind of hawkish side of monetary policy. And while he'll naturally want to stay on Trump's good side, a lot of people think this should help temper those expectations that the Fed is suddenly going to indiscriminately lower interest rates when he takes the job, and the fear of Fed independence comes into question. I think it's worth remembering that one seat doesn't mean policy direction suddenly changes. The Fed chair is only one among 12. And influence depends far more on that person's credibility than just the authority of the seat. But markets took a lot of comfort from the signal that there still is this independence. It still matters. And at the same time, using the chart, the Fed's been able to stay on the sidelines. Rates were left unchanged in this range of 3.75 to 4%. That was as expected, and following those cuts we've seen late last year. Inflation somewhat eased, but is still elevated in the US. Labour market conditions have stabilised for the time being, and while growth is slowing, it's doing it in an orderly way. So that combination of steady inflation, resilient growth, and a credible Fed has really helped anchor expectations, and it's marginally supported the dollar after this volatile movement earlier this week, and that feeds into this commodity story. And then this leads us on to the final theme, and arguably a very important one for US equities, and that's the consumer. The chart tells quite a clear story, and that's that consumer spending has become increasingly bifurcated. So, higher income households, your top 20% of earners, account for this rising share of discretionary spending, and middle income households have stagnated or slightly deteriorated, but it's the lower income consumers that are under a lot of pressure. And this kind of trend matters because equity ownership's concentrated among this higher income household. So when markets perform well, like we've seen US equities and large cap tech, spending power rises alongside them. And that's like a wealth effect at work. There's the strong share price performance in a lot of these AI exposed and tech led names. And that's supported confidence and consumption at this upper end of the spectrum. That's combined with some strong earnings from these tech companies as well. As a byproduct, they're offering strong salaries, and that very much is boosting spending power further. And then at the same time, lower income consumers are still dealing with higher living costs, weaker job security, and less financial resilience. So while the economy continues to grow, it's doing so unevenly. And I've mentioned it before about this K-shaped economy with uneven gains. And it's also the case for the consumer. Picture the letter K with both arms moving in different directions. That's what we're seeing for the US consumer at the moment. And I'm going to be anecdotal very quickly on this webinar. I know we only like facts and figures, but I was at an economics conference last week and it talked about this trend. They got a heat map up of the United States, they color coded it and based the colors on the average household salary. So different shades depended on the strength of that state. So dark green for higher incomes, red for lower. And instantly what you'd notice is the left-hand side of the US is very much dark green. Think of places like San Francisco, San Jose, Silicon Valley, and they're all very much dominated by US tech. And if you took that average household salary for these states, a lot of key Western areas of the US are nearly $100,000 higher than maybe the mid-US, which has your more traditional blue collar jobs or manufacturing that's labor intensive and so on. So very much striking for me, and pictorially, this is what the chart shows. From our perspective, the trend could continue. We've of course got Trump and the one big beautiful bill coming in. There's tax cuts and deregulation that could further push this divergence. So for some, American dream's very much real, but at the bottom end, we can see that these people are struggling. And to touch on this from an investment perspective, we know the US in sterling terms is a laggard against other regions now, and if the dollar weakens further, this could continue. We've seen it recover from this Fed installment, but that doesn't mean active stock pickers aren't useful here. It really does mean that sector outcomes matter much more. Companies exposed to these higher income consumers and capital expenditure could continue to benefit, while the more price sensitive areas can face this pressure. So, if there's any time for an active manager to prove their worth, absolutely, it's now. So, stepping back, three key themes. The first, commodities. We've seen momentum be a detriment recently. It's recovered somewhat afterward, but that doesn't shift away from gold's long-term investment case for, especially for retail investors. It can act as a good hedge. It can provide lower correlated returns. And I'm also talking about broader commodities here. There's copper, titanium, zinc, cobalt. So not just gold. Second, in the US, the Fed is on hold, credibility is restored, and for the moment, policy risk is temporarily reduced. And the third, the US consumer is increasingly K-shaped. That's going to create some clear winners and losers across equity markets, and that's a great time for an active manager. So for us, for the moment, time of discipline, we need to be mindful of crowded trades and just focus on the fundamentals and figure out where growth is really coming from. But that's everything from me. So thank you very much. I'll pass back to Jordan.
Thank you very much for that, Josh. And thank you, everyone, for spending your morning with us. As promised on screen now, the contact details for Josh and I. Should you have any questions about the content we've covered, any themes that we didn't cover today, or if you'd like to hear more about our range of managed and tailored portfolio services. If you enjoyed today's session, we do hope you can join us again for the installment in March, which will be taking place on the 3rd at the same time of 8:50. But for now, on behalf of Josh, me and the rest of the team here at Blackfinch Group, we'd like to wish you a pleasant day and we look forward to speaking with you again very soon. Bye for now.